Welcome back, everybody, to another episode from Coin and Capital. It's Chris, and on this channel we talk macro, finance, crypto, any headlines that impact our investments. We talk about it, break it down, try and find some truth. And today, guys, the Federal Reserve of all people is in the hot seat. So here's the plan. We're going to talk about the Fed, some recent announcements made by the Fed, this monetary regime shift going on around the globe. We're going to talk about some liquidity and how that is impacting current markets. And to finish it off, we're going to touch on some new crypto regulation and check in on how our darling Bitcoin is doing. So stick around. Charts are coming. Truth is on the way. Let's get into it. To kick things off, guys, the monetary regime is here. It was announced the other day by none other, the central bank of the darling of the world. Yes, I'm talking about the USA. And the Federal Reserve mentioned it will start technical buying of treasury bills to manage market liquidity. I mean, guys, don't let the wording fool you. That technical in there is noise. It is all noise. Look at QT, quantitative tightening. The Fed's balance sheet stopped shrinking on December 3rd. And literally a week and a half later, due to nobody wanting to finance the US government, the Fed came out saying they will be the lender of last resort. They will be buying what nobody else wants to buy, right? So in the background, we have that Federal Reserve balance sheet, that white line, continuous slope showing us the quantitative tightening program, all the roll-offs from the balance sheet that went on for far too long, longer than it should have, actually, which is a big reason for all of this dysfunction and dislocation in the markets. Okay, keep that in mind. We should expect, down below in that article, they said up until April will be when they reassess the buyback program. So what we get is from January 2026 to April of large amounts of buying from the Fed. Holy cow, guys. We had the Treasury buying back its own debt, and now the big boy has stepped in, the Federal Reserve, creating money out of nothing to finance the government because nobody else wants to. What does this mean for the dollar? Well, it means we are going to see a DXY, the dollar index, below 98. Remember, a couple videos ago, maybe last video, we talked about easing levels in the DXY. 98 was that kind of threshold we wanted to be below for the DXY, for global liquidity to become a tailwind in risk. And it's happening. It's happening, right? And we have price targets here just from very simple support and resistance lines of 95 and then below down into the 80s. So we should expect 2026 to be another bearish year for US dollar assets. Why? The Federal Reserve had just come out and said they're going to print as many dollars as they need to keep the US government solvent. Meaning the DXY needs to weaken. If you dilute the money supply some more, that currency purchasing power disappears, right? However, for us over here at Coin and Capital, smart investors, intelligent people that look at the data and think about it, right? That doesn't matter to us. That, in fact, is actually a good thing for us. Why? Because we have made the smart choice and smart allocation of resource, our hard worked time and energy, and we have decided to put that somewhere that benefits us over the long term. And no, it's not dollar assets. And no, it's not the S&P 500 that treads water, right? We here at Coin and Capital know better. We have put our money somewhere that performs 50% year over year. Talking about Bitcoin, ladies and gentlemen, right? The DXY below 98 and this inflationary environment is the biggest tailwind for Bitcoin. Brings us to the next chapter in today's video, liquidity and funding, right? Because when the DXY drops below 98, clear signal for the rest of the globe to ease a little bit, right? Funding their debt because it's denominated in US dollars becomes a little less expensive, right? Some extra money starts to float around the system. Hey, maybe we could go buy some equities. Oh, hey, maybe we could buy Bitcoin, right? So the next chapter, let's talk about some liquidity and some funding through the system. What better place to start? The TGA, Treasury General Account, right? We know this here on this channel, the checking account for the US government, right? Short-term tailwind or headwind, depending what that is doing. And that is the white chart in the background here, ladies and gentlemen, with a current balance of 978 billion, just down from $1 trillion, right? So with this government shutdown no longer running, the government has 978 billion to spend into the economy, maybe pass out some welfare and some of those stimmy checks, right? Tailwind in the short term for risk assets, okay? On top of that, 10-year yield. We talk about this literally almost every episode. Get with the program now, guys, okay? Last episode, we wanted to see the 10-year roll over to the downside. Literally not happening, okay? Why is that? Bond markets price risk. The U.S. bond market prices risk of the U.S. as a country, okay? The Fed came out and said, hey, we're going to print as much money as we can to keep you solvent, okay? The rest of the globe probably saw that, looked at their T-bills that yield them 4.5% annually, realized, oh, the Fed can just print more money. Oh, inflation is going to tick up to 5, 6, 7%. Oh, I only get 4.5% back. I'm losing on real terms. Give me more yield. Okay? That is how bond math works. Okay? So, we have this weird dichotomy happening, right? The US needs this super inflationary environment to stay solvent, right? Whereas the rest of the globe sees that inflationary environment as risk, rightfully so, right? They get to a point where they start losing in real terms. Okay, people see the risk, they demand higher yield. The Fed has to print more money to cap those yields. Like, you see this dichotomy going on, right? The good thing is the Fed can print as much money as they need, right? The good thing for us, as smart people that listen to Coin and Capital, we own Bitcoin, the best debasement and inflation hedge we have today. What do these two charts tell us right now? Short term, we have some liquidity tailwind, okay? This TGA should be continued to spend down, right? The government can spend that into the economy, boost spending, X, Y, and Z. Still, on the long end, we have some headwind that needs to be capped for the love of God. Over the next few months now, with the Treasury buying back its debt now, and the Federal Reserve, magic money printer Jay Powell, is now buying more T-bills as well. So, again, into the next month, 2 months, we really would like to see this roll over. Okay, if not, that's an issue. Okay. And then on to some crypto funding. Okay, what we're looking at here is the Aave weekly chart. Now, what we need to understand about Aave, it's this big lending protocol, one of the highest quality lending protocols in crypto. When lending is booming, when leverage is there and people are willing to borrow against their assets, Aave does quite well, okay? When leverage is gone, Okay, lending platforms don't make a lot of money. Okay, we can see here in Aave, it's shown some strength off the recent pullback. Okay, yes, the whole ecosystem has shown the same strength. However, Aave in particular, as it's a very high quality protocol, we can derive a bit more signal from it. Okay, and the way I'm reading this is that when Aave's price rises strongly amongst the crypto ecosystem push, right, perhaps people are willing to take some more leverage in their positions and borrow a little more. Okay, meaning there's a bit more funding going on in crypto, right? People are building back positions after that massive wipeout. Okay, meaning a bottom is potentially forming. Checks out, right? When we put that with our short-term view from the TGA, and then we also looked at the SOFR rate last video, we concluded that short-term liquidity is a tailwind, right? Boosting leveraged positions with this Aave chart, can start to paint a little bigger picture, right? So, to finalize on this video, with all that information, right? Fed's starting QT, the Fed starting QE, right? The DXY is trending down below our 98 threshold, where it becomes risk on, tailwind. Short-term funding is still positive, right? It's really just that 10-year that we need to get rolled over. On this channel, it could be pretty positive to define some next steps, right? We can also begin to look at some macro policy that benefits the crypto ecosystem as a whole, right? Because these things, in fact, do have an important role in developing thesis and allocation. When we look at what policies come out, it's been a good month for crypto policy, honestly. Both from Reuters, US bank regulators says banks can act as crypto intermediaries and then spot crypto products to begin trading on CFTC registered exchanges. Cool. Crypto has finally solidified itself in mainstream, right? It's now a part of institutional offering and products. Cool. What does this mean? It means retail hasn't even shown up yet, right? All of the boomers with brokerage accounts can now access crypto, right? Your mom and dad can access crypto, pension funds, and even literally just anybody that doesn't know how to use DeFi now has on-ramps onto crypto. Okay, that's very positive. So we have short-term funding, positive. QE, buyback program, positive. Inflationary environment, incoming, is a positive. Okay. Ding is returning to the markets, meaning leverage is present, a positive. Now we have some healthy narrative behind crypto, a positive. And when we look at our beloved Bitcoin, we have two charts, weekly on the back, daily in the front. Okay, so we can see this fractal contrast for a second. What is going on in Bitcoin? What does Bitcoin have to say about all of this, right? And I believe Bitcoin paints that the funding is returning, right? We're carving out a bottom as we speak. People are building their leverage back, right? The bull run is not over, okay? How can I tell? When we look on Bitcoin daily, there is a lot of distribution going on, okay? We can tell there's distribution because the price just moves sideways, right? Someone buys, someone sells, someone buys, someone sells, someone sells, someone buys, right? It just, a lot of coins are switching hands, right? Which we saw at the top before that big plunge. We're seeing again, potentially at the bottom, okay? And all of those lows are people building positioning, right? And on the weekly, nothing's changed since last video. We're still sitting at that fib level. We're still at weekly discount. Things aren't too bad on the weekly. On the daily though, if we really want to see that distribution occur, that's where we're seeing it. makes sense, guys. Okay, makes sense. The biggest takeaway from this video: the Fed is ending QT, has ended QT. The Fed is printing money to buy back the US debt. Guys, last time that happened, housing prices shot up like 4x. Right? Last time we did that, Bitcoin went from like, what was it, like 10 to 60, 70K? Okay. Meanwhile, Bitcoin has gone from its bottom to 126K, all while quantitative tightening has been occurring, right? And people are willing to call that the bull market is over when the entire macro backdrop and monetary regime is about to flip on its head. To me, that doesn't make sense, right? To me, that's just totally irrational, okay? Because with this QE, if you want to call it QE, right? The Fed is buying back treasuries. With this QE comes money printing, comes inflation, okay? Inflation is necessary, and Bitcoin thrives under inflationary environments, okay? Position wisely, stay safe, stay smart. I'll catch you guys in the next video.